A very good morning, ladies and gentlemen. Good morning, Frankfurt. Good morning to our guests from 8 regions and countries. We're again 1 hour ahead of London and happy to have you all here. It's the 33rd Financial Center Breakfast together with our partner, and our topic today is Gapponshugi. The topic of Gapponshugi was put onto the agenda by Mr. IG, and it is equal to the fact that ethical aspects are getting integrated into the world of capitalism, into the economic world. Again, it's time to look to Japan, like in the 1980s, late 1980s and 1990s, where at that time, I still vividly remember, all in the West went on to Japan to learn as much as possible from them. And now we are back that Gapponshugi, the integration of ethical aspects into the financial world, is brought from Japan to the rest of the world. I have to apologize. My screen is running a little bit too fast for me, so I'll try to catch up here. By this integration of ethical capitalism, which goes back to the 19th century, it is very much like what we see in today's Western companies that pay attention only to share prices, whilst the Japanese companies had cast an eyesight already on stakeholder value then. And now we are happy to have Jim McCafferty, the joint head of APAC equity research of Nomura, who will address the topic of Gapponshugi in an ESG world. Jim joined Nomura in 2015 after a stint with Royal Bank of Scotland in Hong Kong, and before he had leading roles in London, amongst others with Societe Generale. He was awarded the Financial Times Alternative Investment Management Analyst Award, and he studied in the University of Sheffield, where he held a master in political science. Dear ladies and gentlemen, do not hesitate to enter your questions onto the Zoom link. And with now no further ado, I'd hand over to Jim and go off screen. Jim, we're very much looking forward to learn about Gapponshugi.
Okay, thank you very much, Hubertus, for those words of introduction. And from me, I've got a bit of housekeeping to do as well, because I understand that in the audience today, we have your chairman, Gerhard Wiesheu, who has been very supportive and is very supportive to Nomura's efforts, not just around the world, but also in Frankfurt. He's also, I understand, a fluent Japanese speaker. So if there's any confusion around the terminology, then please reach out to him. So I guess a little bit of background before I get to the meat of the presentation. And as Hubertus rightly said, what I want to talk about is Gapponshugi in an ESG world. And I remember many years ago being a student at university, and my professor would always tell me, before you start something, you must define the terms. So I think now is an opportune moment to give you a bit of background. So Gapponshugi itself, as Hubertus referenced, my interpretation of this is ethical capitalism. But before I came on this program this morning, I sent an email to a number of my colleagues in Japan and 3 particular colleagues to ask them what is their interpretation of Gapponshugi. And predictably enough, I got 3 different answers. In Japanese, often things are slightly difficult to translate. But I think one thing which I think summarizes it is Gappon itself means to bind several books together into a volume. And I think in terms of Gapponshugi, what it really means is that capitalism should not just mean deference to shareholders, it should mean deference to other stakeholders, including employees, suppliers, and the wider community. Other ways of interpreting Gapponshugi could be cooperative or community capitalism or coordinated capitalism or even combined capitalism. The idea is that capitalism doesn't just mean making profit for the shareholder, but making a big contribution to society and other connecting stakeholders. ESG, on the other hand, I'm sure many of us are familiar with, but basically it references environment, society, and governance. And in particular today, in terms of Gapponshugi, I really want to address the S part of that particular three-letter acronym. So if we can go into the first slide. Yes, so the second slide in that case, which is ESG Investing, the future starts here. So really a few things which I wanted to identify to set a bit of a scene as to the topic for today. And if we look at the top left-hand side, I wanted to give you a bit of an idea of the genesis of ESG. And that goes back to something called the Principle of Responsible Investment, which was published by the United Nations back in 2005. And over the course of the last, say, 2 or 3 years, ESG investing has really accelerated. And I think there's 2 or 3 points in time that I want to reference. If you go back to 2019, back in September of that year, the Business Roundtable in the US, which is a bit like, I guess, the Kaidanren in Japan, it represents lots of big businesses. It decided to move away from what it called the Friedman Doctrine. And many of you, I'm sure I've heard of Milton Friedman. I myself studied economics at university 30 years ago, and Milton Friedman was a pioneer of the free market. And he in particular advised big business simply to put shareholders above any other class of stakeholder. That seems to have changed. And back at the end of 2019, big business in America acknowledged that other stakeholders should be included as a priority for lots of companies. Now, specifically, back at the World Economic Forum in January 2020, the theme of that event was stakeholder capitalism. And of course, that was at a time where we were at the beginnings of COVID-19, lots of social unrest, lots of dislocation, things like Black Lives Matter protests. And it really brought into the frame the fact that companies have got lots of other stakeholders to look after, as well as just a shareholder. So let's move forward to 2021, this calendar year. And the big theme at the World Economic Forum in Davos, which again was virtual, a bit like this forum, was the Great Reset. And basically businesses having to reset what the priorities actually are. Now, bringing that into investing, if you look at the middle panel, the top of the slide, what I want to really identify here is if you look at the consulting actuaries who often advise the asset owners on how they should prioritize their investment credentials, then you can see that all of the things we have identified, you have a much bigger uptake in terms of how investors are actually bringing in ESG metrics into their investment decisions. So to give you an example, looking at plans integrating ESG into investment policy, 68% of investors talked about it in 2019. Now it's almost 19%. And again, if we shift to the right-hand side, you can see again here, in terms of governance, beliefs, and policy, that 88% of policies are making reference to ESG, and that compares to a much smaller number at this time last year. So the trend for ESG engagement is increasing, and I can show you lots and lots of charts on this, which shows you lots of metrics. For example, the amount of money is committed to ESG investing tripling over the course of the last 12 months. So looking towards the bottom left-hand side, what I really wanted to share with you today is that on the one hand, you've got the US becoming more cognizant that it needs to look after not just a shareholder, but other stakeholders, including the employees, including society. So big companies like Apple, big companies like Amazon, they're now making bigger charitable donations. They're letting people work from home. They're getting more diversity in the workforce. On the other hand, in Japan, where these, I guess, employee type behavior to really support employees has been part of the fabric of the way companies have been run, they're now becoming much more disciplined in terms of shareholder priorities. So things like dividends are becoming more and more relevant to company managers in Japan, and that's evidenced in the way that companies have been treated over the course of the last year or so. Again, towards the right-hand side of the slide, I would say looking at the 4 big geographies in Northeast Asia. Now, if I take Asia Pacific as one single equity market, the biggest representation in the equity market are these 4 big geographies I've identified here: Japan, China, Korea, Taiwan. In Japan in particular, a large institutional investor called GPIF, which represents lots of employees of Japanese companies, are actually pushing for more engagement between management and shareholder. And that's encouraging dividend growth in Japan. So the G part of ESG in Japan is more sophisticated. Again, this is happening in China, driven by the institutional investor. In Korea, National Pension Service, or NPS, again, pushing the same agenda. So I think, what we're seeing is that Asia actually is driving a lot of the behavior which is ESG centric. And that, I think, stands in good stead for how APAC as a region will be perceived by the investor base. So I think if we move to the next slide, what I wanted to do here was to reference some of the academic literature in terms of how Japan has been perceived. And Hubertus correctly identified in his opening words that Japan was seen as, I guess, a bit of a geography where industry was working well with shareholder priorities through the 1980s. And of course, then the Japanese bubble burst back in 1989. But I think if you look at some of the literature out there, what it identifies in the early 1990s is that, going to the middle of the top of the slide, you can see a quote from Karl Kester, which said that the Japanese managers are agents of the entire coalition of stakeholders rather than any other single group. So shareholders weren't just a priority, many other stakeholders as well. Eric Orts, similarly, he talks about the coalition of stakeholders, suppliers, lenders, customers, shareholders, holding a complex blend of senior and junior, short-term, long-term, conditional and unconditional, implicit and explicit claims against the company. So who does the company belong to? Now, if you ask that to a conventional Western investor, then they would always say the shareholder. But looking at the left-hand side, you can see in terms of the business, here in Japan, in the case of it relative to other geographies, many, many other stakeholders, not dissimilar to Germany in many ways in terms of the way that business has been run. So I think this is important because I think if you go back to the early 1990s, and I remember very clearly as a graduate trainee with County NatWest, I was advised by the various courses I went on that companies should be designed to maximize value for shareholders. And I'll give you one example. Marks and Spencer's, which was a fairly famous and still is a British retailer, in those days they did a lot of clothing. And I always remember my tutor telling me that in the case of suits, which I'm wearing right now, you go into Marks and Spencer, you would buy a suit, and Marks and Spencer would get the money for that suit immediately, but they wouldn't pay their supplier in Leicestershire, part of regional England, for 3 months later. And that was seen as a good example of managing working capital. So squeezing the supplier to the benefit of the shareholder. Now that has gone out of fashion, and the kind of Japanese capitalism, which we have as identified on the left-hand side, is now much more popular and comes back into ESG fashion right now. So I think that the kind of message I want to convey from this slide, and really referencing the academics, is that the system which we have had in place in the US, which is often called stockholders theory, or driven by Milton Friedman, and Milton Friedman's concept was that the firm's sole responsibility and only responsibility was to its shareholders. He took the view that everything else would work itself out. On the other hand, and to quote Ronald Dorr on the bottom middle of the slide, you can see that the rights of the owners are seen to be amongst the rights of not just shareholders, but employees, customers, suppliers, local communities, etc. So that's a bit of background. So again, moving forward to the next slide, what I wanted to share with you is, again, a bit of the academic literature which has been published around the whole concept of stakeholder capitalism. And this is some of the material which I think many of you who might have studied Japan back in the 80s or 90s would have come across. This is kind of standard literature. And some of it quite appeals to me. I worked for Nomura for 6 years, so I can see this in action in many ways. But the first reference I wanted to make was the Abegland study, which was done back in the late 1970s. And the whole idea was that Kaisha, which is a Japanese corporation, the questions that we had then was, who does the Kaisha actually belong to? And one bit of exercise that was done back in the study, which was produced in 1979, is that they asked the question, if you prioritize who are the different stakeholders, where do they rank in terms of forced ranking? Now, in the case of a US company, the US company managers would always prioritize the shareholder. That would always be number one, or Ichiban, as they say in Japan. In the case of the Japanese company, shareholders would always be last. And at the beginning, there would be employees, suppliers, and customers. Now, one thing which I thought was also interesting is if you look at the management teams of the US companies, then you would typically find that the management was made up of the non-execs and the executives. In the case of Japan, you would have a lot of the executives being part of the employee union. So the way that Japan works is that unlike businesses, let's say in the UK or in continental Europe, where in unions are made up of different trades, let's say it's electricians, let's say it's ship workers. In the case of Japan, the union is made up of employees only, and a big union representation on the boards of companies. Again, not dissimilar to Germany. So that's one piece of background. The other one I want to share with you is, again, a British academic called Ronald Dorr, who produced a study called British Factory, Japanese Factory, based on an analysis of the English Electric Company in 1972 and Hitachi Company in Japan, and some interesting parallels. And I can really identify with this because as a student many, many years ago, I had a job working in a British factory. And I can assure you that the thing that Ronald Dorr discovered, as soon as the signal comes at 3 o'clock or 4 o'clock in the afternoon, where the shift is over, then what you would find in the UK is the British worker would be running to the gate to catch a bus, whereas in Japan, the employees would hang around and spend some time with their colleagues, which I guess, of course, is more conducive to a stronger working environment. So that's a bit of background. Moving further ahead to the next slide on page number 4. A couple of things which I wanted to share with you. Again, another piece of academic work which was done by a gentleman called Chalmers Johnson. And here he found that in the case of Japan, you had a very strong connectivity between the government and the way that business was run. So if you think about post-war Japan, we had a strong investment in strategic industries. And those were things like shipbuilding, things like automotive and electronics. And therefore, the government was kind of to give some guidelines to the private sector as to how they should invest capital and where they should point it to. So this was called administrative guidance. And this is completely at the antithesis of, let's say, some of the Thatcherite policies we had in the UK in the 1980s, which again had their genesis in Milton Friedman. So administrative guidance was again something which is steeped in the history of Japanese capitalism. So going to the right-hand side, I wanted to talk a little bit more about this gentleman called Shibusawa-san. So Shibusawa-san is widely known as the father of Japanese capitalism. And for various reasons, which I'll talk about later, he's becoming more and more in vogue in Japan right now, partly because of ESG and partly because of other reasons. But during my research, I came across the idea that Shibusawa-san basically embraced a lot of the positive things about capitalism from Western countries. And the genesis to this is that back in 1868, we had something in Japan called the Meiji Restoration, when Japan opened itself up to the world and embraced ideas from Western societies. And ultimately, if you think back to the legacy of Japan, which dated from 1603 to 1868, Japan was closed to society. It went through something called the Tokugawa period. And during that time, Japan did not interact with the rest of the world. And Japan had a very stratified society. So at the top, you had the samurai class, and below that, you had the merchant class. And the merchant class, which was involved in business, was seen as slightly unethical. It was possibly seen by Japanese society. It was very difficult to make money from people without actually doing them a disservice. So that's a bit of the background. So what happened back in 1968? You had this Meiji Restoration, and some of Japan's leaders were sent to learn from the West. And during that whole process, Shibusawa-san was sent to Germany, he was sent to France, and he came back. And what he communicated to his colleagues and other stakeholders in Japan is that capitalism and community service can be two sides of the same coin. So basically, ethical capitalism. And this actually contradicted a lot of the kind of Confucian values that were in place in Japan at that time. And Shibusawa-san went on to set up the Japanese Red Cross. He founded the Japan Women's University. He founded Daiichi Kangyo Bank, which became Mizuho, one of our major competitors in Japan. And that legacy lives on today and very much sits very nicely with this whole concept of Gapponshugi. So if we move on a little bit further, this exhibit really is designed to show that Gapponshugi lives on to this day. And this is really for the benefit of those that might have some interest in Japanese society and what's going on right now. But there is a program on NHK, which is Japan's main television channel, a bit like the BBC in the UK. And the program is called Seiten wo Tsuki, which means Reach for the Blue Sky. And this is a 45-part series. And we just started this on the 14th of February. And every Sunday evening, there's a dramatization of Shibusawa-san. The very handsome gentleman on the left is a gentleman called Yoshizawa Ryo. He is playing Shibusawa-san right now in that program. And in the middle, I've just identified the fact that the latest circulation of currency in Japan, which is changing in 2024, will feature Shibusawa-san on one side of the note, and that's worth roughly $100 US. On the other side, you can probably see this is Tokyo Station, right next to Nomura's office in Muru. I think it's called I've forgotten the name. I will come back to me again. Marunouchi is where it is in Tokyo. So this is happening right now, which again, raising awareness of the whole idea of ethical capitalism. So I think turning on to what it means for investors on page number 6, what I have given you here is a little bit of background to how Japan fares relative to other geographies. And Japan, as the third biggest economy globally, happens to have the second biggest stock market in terms of MSCI weight. For a number of reasons, MSCI, which is one of the index providers, chooses to have Japan identified as a bigger geography than China because it believes it's been more investable, more like a Western market. Now, what's quite interesting is that in the past, a lot of investors have tended to move away from Japan because they kind of felt that Japanese companies were not spending money rewarding their shareholders. They were spending money on other things like rewarding employees, like rewarding suppliers, customers, or communities. But actually what's quite interesting is 2 or 3 things I would highlight. Number one is that Japanese companies on the whole are quite conservative. And if you go back to the whole idea of Milton Friedman, which is shareholders first, if you are adopting that policy as a management team, what you would tend to do is try and leverage up the balance sheet to make sure that you've got a very efficient capital structure. So what that means is take on more and more debt, because as a company with lots of debt, you get tax relief on the interest costs, which means you leverage up the returns for shareholders. Now, that's all very well at a time when you've got a normal world. But of course, you have COVID-19, and then companies are finding that business conditions do deteriorate, and for that reason, they're looking to go back to their shareholders to raise more capital. In the case of Japan, because it's very conservatively run, you tend to find that most companies have got an abundance of cash sitting on the balance sheets, and what that means is that despite difficult trading conditions, they can continue to pay dividends even during times of disruption. And that's something which we found over the course of the last 12 months has been very much the case for Japanese companies. So to give you some examples, on the right-hand side, we've looked at some of the context around the Japanese banks, for example. Despite the fact that earnings have been under pressure, these companies have been able to continue paying dividends. In the case of Suzuki Motor, same thing. Auto demand was down at the beginnings of COVID-19. And again, the company was able to sustain its dividend payments. So I think on the one hand, Japanese companies were, I guess, to a certain extent persecuted by investors for not being shareholder friendly enough. But having had that very cautious approach towards managing their balance sheets, they're now able to deliver for shareholders in the form of dividend increases. And to that end, if you look at the table up on the right-hand side, there's an annual survey conducted by Janice Henderson looking at dividend payouts. And the Japanese companies are managing to grow their dividends faster than any other country which is relevant to the global investor base. Now, I think this is really important because as we all approach retirement, we're thinking about ways of generating income from assets and also generating a growing income from assets, especially as inflation appears to be coming back. So from that perspective, because of these strong balance sheets, Japanese companies are able to not just grow dividends, but grow them faster than other asset classes. And from an inflation proofing point of view, that's the sort of asset that we would advise investors to have in their portfolios. So I guess in terms of stock selection, and page number 7, which is the next slide, I guess I've got to be mindful that the audience today might be slightly different from what I'm used to. Most of the investors that we interact with, they always want to have ideas, which companies should we be invested in? Now, what's quite interesting for me is that I've looked at a lot of the global income funds. So many investors, especially Western investors, they put together different products for their end clients. And income funds are quite popular these days because as an investor, there's very little returns you can get from your Sparkasse, let's say, in Germany. So where do you actually find some decent income? And what's very interesting is that a lot of these companies which provide these funds, investors such as Janus Henderson, investors like Templeton, investors like Jupiter, for example, you'll tend to find that they are simply focused on European and US names, very little exposure to Asia, and very, very tiny exposure to Japan in particular. And looking at the composition of the portfolios that are in these funds, you'll typically find it's Swiss names, for example, some of the healthcare names, a lot of UK names, for example, but very little attention paid to Japan. Now, here I've identified a list of companies which are giving you, you can see, double-digit earnings dividend growth over the course of the last 9 years. So again, being invested in one of these companies, let's say you put 10,000 euros into one of these companies, not only are you getting, let's say, 500 euros a year, that 500 euros is growing at more than 10% a year. And that's exactly the type of place that we think safe money will want to be. And given the way that Japan is run in terms of Japan Inc., I think we're in a very good position to actually find these companies as part of the income portfolios. So that gives you a bit of, connecting the way Japanese companies are run into what it means for investors. And I'm very happy to take some questions at this point. So I'll move back to you, Hubertus.
Yeah, thank you very much, Jim, for your very insightful presentation. And first of all, I learned so much about Japan. Thanks for that. And my first question would be, and it's very much a Western perspective, and it came obviously here from Frankfurt, is the question: to what extent do activist investors they complain that they are not made heard in Japan, and to what extent do they play a role to change it? Or was it partially also encouraged by the government that they should become more activist, that played a major role? And how was that balanced with Gapponshugi?
Yeah, so I think it's a really good point. And I think be mindful that Japan, a bit like Germany, it has got a certain cadence to it, a certain way of doing things. And I think we've seen a lot of very assertive and aggressive, especially US asset managers, come into Japan and try and agitate for change. One of those back in the 2006-07 period was Steel Partners, which I think came in to try and agitate for change at one of the major Japanese companies and just failed. What we're seeing now in Japan is that activists are actually local. Over the course of the last few years, you've had a number of Japanese asset managers set up an active management part of the organization, and they have much more success. The way to get change in Japan is to do things in a low-key way, rather than go through the Financial Times or through various newspapers to communicate your dissatisfaction. It's best to have engagement with management. We're seeing more and more of that. Now, right now in Japan, we have something called the AGM season, where all Japanese companies meet with their shareholders. In fact, I think on the 29th or the 28th of this month, something like a quarter of Japanese companies will meet with their shareholders and have a dialogue with them. And that's the opportunity we're seeing local asset managers actually have that dialogue. So I think if you look at one metric to show that progress is happening, share buybacks. I mean, again, going back to capital structure, one of the things I talked about is the fact that Japanese companies can be seen to have lazy balance sheets, lots of cash on the balance sheet. And therefore, a lot of investors feel that that cash should be returned to those investors so they can redeploy on behalf of the asset owners. That's now beginning to happen. And that's, I think,
but you made the good point that these cash on the balance sheets help them to stabilize and steer through the crisis. So how is a new balance found there?
Well, I think ultimately it is a combination of both. I think if you go back to the exhibit that we talked about at the beginning, you've got the West going in this direction and Japan going the other direction. I think there's a happy medium. And I think, right now, pension funds in particular, given demographics around the world, need income in order to satisfy liabilities. So actually Japan is now being viewed as an asset class that can generate income. So I think right now, Japan is probably too far to, let's say, the left of the diagram. It's moving to the right. It's got a bit further to go, whereas the US is going the other direction.
Yeah. Here in the West, we have a lot of talk about taxonomy and when it comes to ESG and multi-stakeholder capitalism. So is there also something already to learn from Japan? Do they have built such a taxonomy on which the corporate should reference themselves?
So I think, Hubert, it's very, very subjective. I mean, what I've noticed in the engagement we've had with investors around ESG, the one thing which appears to be measurable is the E part of things. And people talk about carbon zero, but I think the S part of things is really much neglected. And if you think about the traditional composition of a stock market index, you would have many oil producers, coal companies, for example, which are producing externalities, but also many companies giving a lot to society. Apple, for example, doing a lot for the homeless in California. Sony Music, for example, providing a fund for artists struggling during COVID-19. I would say it's very, very difficult to measure this stuff. And we have a number of agencies out there who we as investors can pay them to guide us on what the ESG credentials are. I think the issue we're having is a definition. So one, for example, MSCI will tell me that Toyota is one of the best companies in Japan. If I ask Nikkei, they'll tell me it's one of the worst companies in Japan. So there's no real consensus now. So right now, a lot of subjectivity.
Yeah. You have mentioned early on that the state is one of the key stakeholders very early on from that thinking. You made as an example the industry that were built used to for in the period of reconstructing Japan. Does the state still play that big role? Does Japan Inc. still exist?
I think it does. And in Japan, you've got something called the Iron Triangle, which I think is really the government, the bureaucrats, and big business, led by something called the Keidanren, which represents big business. So that's still there in practice. But I think ultimately, all of these companies pay tax. And if you think about big tech in the US and the fact that it's doing its very best not to pay tax, I think shows you a very different attitude towards government. So, while we have the Iron Triangle in Japan and METI, the Ministry of Economy, Trade and Industry, having a directional role, I think there's just a general view that Japanese companies should pay their tax bill as well as paying shareholders. And that's very different from the attitudes we have in the US.
Okay. In May this year, the companies were asked to have more independent directors on their board. How does that fit into the picture?
That's beginning to happen. And I think in the case of Japan, right now, for the big names in Tokyo, and let's say the top 100 companies by market cap, I think pretty much all of them have got two kind of external non-executive directors. And I think also trying to find more and more women to join boards of companies, and especially foreigners to join these boards as well. So that's beginning to happen as well.
Yeah, you mentioned women. That's a very good example. Japan is known for a very low female work participation rate. How does that relate to it? Is that sort of part of the concept or a contradiction?
Well, I think so. So again, I mean, in Japan, there was something I remember called the M curve, which basically, as you can imagine, goes like an M. So female participation goes up, then it drops with fertility, then goes back up again. One of the initiatives which Abe-san had under Abenomics was to try and get more engagement with women in the workplace and to mobilize women into the workplace through the provision of better childcare. So that's something which is an active program right now.
Yeah. Whilst I want to encourage our guests to give in new questions, we're basically through the questions from the audience. Here's the next one coming in. I want to quote the European Bank of Reconstruction that said the state strikes back. And like you said, Japan is a little bit moving towards more of a shareholder orientation. The West is giving ever bigger role to the state. Where do you believe both will meet likely?
I think Japan is advancing quite quickly in terms of the adherence to a shareholder-friendly attitude. We're seeing that specifically in share buybacks. We're seeing it specifically in dividends. And I think we're probably going to see it in M&A activity. One of the things about COVID-19, which has actually hindered Japan in terms of domestic M&A, is the fact that due diligence has been very difficult because traveling around to look at factories and infrastructure has been difficult. But I think ultimately, as soon as COVID-19, when it ends or when it gets easier for companies and advisors to move around the region, that will probably precipitate a bigger boom in M&A. And again, that will be good for shareholders. So I'd say Japan has probably got 25% more to go towards, let's say, a Western style of running a company, whereas the West has got a lot further to develop in terms of becoming more Japan-like in terms of its ESG adherence.
The next question refers to Tokyo as a financial center. Tokyo is competing, of course, with Shanghai and Hong Kong as a financial center. And the question here is that layer of regulation hindering probably Tokyo as competing with these more Western-like financial centers like Hong Kong, or more inward-looking China, inward-looking financial centers such as Shanghai?
Well, I think the thing, again, is to look at his legacy. I mean, let's go back to the late 1980s. At that point in time, Japan was 45% of MSCI World, and you had lots of foreign investment banks trading in Tokyo. So they were there before. And ultimately, I think now there are competing venues, but there is, I think, an initiative from the Japanese authorities to try and attract more foreign banks into its market by lowering tax for some of the participating employees. So the government's trying to do something about this, but be mindful, if you go back to the late 1980s, when Japan was the place to be, a lot of foreign participants were in that market. So I think, having been through it before, the likelihood of it happening again, they're better prepared than most, let's say.
Yeah. The next question from the audience says, what can Western companies learn from Japanese companies about culture, about leadership?
Okay, so I think one thing that's very interesting is going back to employment. And if you look at the way Japanese companies have been historically run, let's say post 1945, there are several things around Japanese employment policy. One was lifetime employment. So when you left, let's say, university and joined a company, you were generally understood to be with that company for life. So that meant the employee would always commit him or herself to the organization. And something called relationship trading or relational trading, where there was an understanding between employee and employer that there was a lifetime contract in place. So that was number one. The other one was something called seniority-based pay. So as you progressed through the organization, agnostic of which role you were doing, the actual pay would go up. And then the final one is something called employer unions, where everyone in the organization was part of the same union, which would represent employees, not dissimilar to what you have in Germany. So those are three things, I guess, the West could learn.
Yeah. When we look back at the time of 1989, when the Japan stock market reached its peak, and there were almost like two lost decades for the stock market, where and we have only seen very recently reach back to those levels. Did Gapponshugi hinder the adjustment process after the bubble bursted?
I think it probably did, actually. So if you go back to 1989, be mindful that the Japanese stock market got to 80 times earnings. So right now, we think the US equity market's expensive on 25 times earnings. Japan was on 80 times earnings. So it was a genuine bubble. Then, of course, we had those 2 decades of, let's say, the lost decades. But those were not just about the stock market decline. It was the decline in economic growth, which went through, let's say, late 60s and 70s at 10% plus a year. That was unsustainable. So, yes, I think perhaps the whole Gapponshugi got too far because companies were slow to adjust to shareholder requirements. But now, I guess with the Nikkei close on 30,000, it's up threefold from where it was, let's say, 10 years ago. So I think we've moved away from that now.
Yeah. When we look at ESG, it has got 3 capitals, E, S, and G. And you rightly pointed out that in the West, the E part is very much in the focus, where you said in Japan, the S part is in focus. Let's turn to G. G is an interesting question. It's been done a lot of research about that G actually impacts performance of companies most. Where do, relatively speaking, Japanese corporations stand versus Western corporations' governance issues? And how does Gapponshugi influence it?
So there's something called the Stewardship Code, which had its genesis in the UK back in 2012. And it was really a kind of system or protocol around how shareholders should engage with companies and get what they want from companies in terms of the outcome to suit the actual asset owner. Now, Japan, through Abenomics, actually embraced the Stewardship Code back in 2014. And it's been implementing that through something called the GPIF, the largest shareholder of public companies in Japan. It owns 8% on average of every Japanese company. So that Stewardship Code is actually being used in practice right now in Japan to the benefit of the end shareholder.
Yeah. Japan has now 20 years of experience with low interest rate environment, low inflation environment, and part of Abenomics was also to increase the level of inflation. Is inflation now coming back in Japan?
Well, I was talking to one of our guys in Tokyo this morning, and if we look around some of the sectors which are positioned to exploit the increased demand for natural resources we're seeing right now, then they're in a strong position to increase prices. So if we take Komatsu, for example, which makes these earth-moving trucks, a bit like Caterpillar in the US, there's a good example of a company which should be able to pass some price rises on to the end consumer. But ultimately, the customers of Komatsu are not really Japanese companies, they're international companies. So actually domestically, with an aging population in Japan, it's very difficult to get inflation back up again. But for some of the corporates, yes.
Yeah. Okay. And in the low interest rate environment, what actually should investors, should corporates learn how to adjust in such an environment? Because somehow it feels still new in the West, even though we have also already a couple of years going, but somehow it seems the majority have been waiting to go back to normal, but the new normal seems to be stabilizing. What changes in the economic dynamics in such a low interest rate environment for such a long period of time?
Yes, so I think investors need to be more adventurous in terms of how they adjust portfolios to deal with inflation. In the past, if you go back 20 years ago, government bonds would deliver a coupon of, let's say, 5%. So mature pension funds could just be invested in low-risk bonds and get that income every year. That's not happening now. With all of this quantitative easing, all this money being pumped into the system, bond yields are down at rock bottom levels. So asset managers need to be a bit more adventurous in finding areas which can develop income. And again, going back to Japanese equities, there is an asset class that not only pays an income, but can grow that income faster. So again, if we try and get your portfolio adjusted to beat inflation, as someone who's about to retire, you want a portfolio that doesn't just give you income, but increasing income every year. And that's why dividend growth, which again, Japan ticks the right box for, is going to be very, very important in the future.
Yeah, that's interesting. And the next question here, coming from Slovenia, by the way, is also saying, do you see an impact on performance of the corporations by being socially responsible in its management? Does it have a measurable impact?
Yes, I think it does. I mean, ultimately, a company which prioritizes, let's say, other stakeholders like government, like local communities. So a company that pays its full tax, a company that might build schools and universities locally to deal with the local community. That money could, of course, go back to shareholders through buybacks or dividends. But ultimately, in an ESG world especially, investors will put a higher multiple on companies which are ESG compliant. So those companies which don't just look after the shareholders, but look after employees, society, and suppliers and customers, they will be afforded a higher P multiple. And for that reason, investors will be rewarded through better capital appreciation.
Yeah, Japan has been steering itself very well through the period of upheaval after the pandemic. And if I compare it to Germany, we have like 8 times the mortality, relatively speaking, to the population. What role did companies play in that process to sort of safeguard the population? Was there any difference?
I think it's a really interesting angle, and I did a bit of work on this last year. And if you look around East Asia, then Hong Kong, Taiwan, Korea, Japan did a good job relative to Western countries in terms of containing the virus. And I think it comes down to the fact that people are, as a whole, more deferent to government. And I think it comes down to teaching and the family units. And if you look at, let's say, countries like Germany, countries like the UK, countries like the US, people like to have their own ability to express themselves. So I think in terms of companies, what I see at Nomura, we're one of the biggest. In fact, Nomura was the biggest company in the world back in 1989. But what I can tell you is, from our perspective, you tend to find you get a direction from above, you tend to follow it. So I think deference in society has really helped a lot with the containment of the virus. Where the issue is in terms of now is the vaccine rollout, which has been quite slow.
Yeah, and even more striking is a contrast to the rate of vaccination. Was it because of what I've been told, and that there is a little bit more safeguard, a little bit more testing, that one felt not comfortable with vaccination being developed so fast? What's the story behind it? And secondly, what's a catch-up strategy now in Japan? I understand that now a massive vaccination project is underway.
Yeah, so I spoke to my colleagues in Tokyo this morning, and I understand that by September, it's hoping to have achieved the same sort of vaccination success we're seeing in Western Europe, for example. But I think when it comes down to the beginning of this year, I think it was just, let's say, a bit of complacency. Now, we've seen this with Taiwan, especially. Taiwan had the experience of SARS back in 2003 and actually managed to contain the contain the virus spread locally and opened its doors too quickly and became a little bit too complacent. I think there's elements of that in Japan as well. So I think, having handled things really well last year, they probably felt quite pleased with the progress and felt they could therefore relax a little bit, and probably a bit too premature.
Yeah. Let me get back to the role of the state. Whereas we see in the West the increasing role of the state, do you see in Japan a continuation of the relative decline of the role in the state in the economy, or are we seeing a plateau now?
No, I think actually, if you think about Japanese companies in particular, I mean, if you look at the big names in the Tokyo Exchange, then you can see the traditional names such as Fanuc, Komatsu, and Toyota. But you've also got some other companies in there, like Softbank, for example, which is, a company which has grown by acquisition, through some very bold acquisitions, has got lots of assets outside of Japan. These companies and their leaders are shaping the way that Japan behaves as a country and society. So I think, while
sorry to interrupt you here, Jim, but isn't Softbank the antidote of the traditional Japanese company?
Oh, very much so. But if you look at the stock market composition, what's very interesting is you take the US, it's a very concentrated stock market index. So Amazon, Facebook, Apple, for example, dominating those indices. Whereas in Japan, you've got SoftBank alone, right, with all these other traditional Japanese companies, for example. But I think in terms of its influence on Japan, and other companies like Rakuten, for example, are behaving in the same way, and they get a lot of attention in the media in particular.
Mm-hmm. Excellent. Jim, it looks like we're drawing to the close. You've been answering the questions perfectly, and I would like to end up with a little remark here in the F&A from our president, Gerhard Wiesoy, who wanted to thank you very much for your inspirational presentation of Gapponshugi. It's been great. Thanks so much, Jim, for these wonderful Q&A, for the wonderful insights into Gapponshugi. I think we'll have a way to go, and I like to quote you here, whilst Japan has probably 25% more to move towards the West has a significant higher way to go. So we meet in ESG, and clearly the S becomes more important in the West after the pandemic. I suppose CE will increase a little bit in importance in Japan as well, as on governmental issues. I think we'll both sides are very alert. Ladies and gentlemen, the event draws to a close today. Thank you very much for your time. We're looking forward to your participation next time again. Have a nice day, and all the best to Hong Kong for you. Jim, we'll stay tuned on what's happening with Gapponshugi. Thank you so much.
Okay, thank you very much.